Good morning and welcome to the Killik and Co market update. This week we have seen some weakness in energy names such as National Grid and SSE, and the reason for this is a proposal that's been published by Labour called Bringing Energy Home, and it's all about nationalising our energy networks. Now previously it was thought that if Labour were to get into power they would first focus on nationalising water utilities, so this new focus on energy networks has taken a few investors by surprise. And within this proposal, Labour have said they believe they would be able to nationalise some of these companies at prices below the current market value. Now, many do doubt whether or not this would be legal, but another strong argument against it is the fact that a lot of normal people, pensioners, do hold shares in these companies within their investment accounts and their pensions. So if Labour were to nationalise these companies at prices below the current market value, a lot of normal people would lose out. And of course, the companies themselves have reacted quite strongly against these proposals. SSE, for example, has come out and said that the cost of energy has actually declined by 17% since these companies were first privatised. And National Grid has come out and said that actually they have made huge progress in the transmission of renewable energy. Now, obviously it's all up in the air at the moment because this proposal really depends on whether or not Labour get into power and whether or not they have a great enough majority to get any of these proposals through. But in the meantime, I think proposals this extreme will serve to have quite a big negative overhang on sentiment for companies in the energy sector. And also this week, Vodafone has announced that it will be cutting its dividend by 40%. Now, before this announcement came out, the dividend was very high at a level of 9%. And even with this 40% dividend cut, the dividend will still be 5%, which will still be a reasonable level. That said, the 9% dividend yield was technically affordable for the company, and for the last year the company has been adamant that that dividend would not be cut. So the news this week will have served as quite a big disappointment for a number of income investors. But for us, it does serve as a reminder that we should be looking at the high-yielding companies in our portfolios and really thinking about whether those dividends are sustainable. And the measure we like to look at here is called the dividend cover ratio, and it simply measures how affordable a company's dividend is. So for example, if a company has a dividend cover ratio of 2, that means that it's earning profits and it's only paying out half of those profits in the form of a dividend. So that says to us that if the company's profits fall, that dividend should still be safe. If a company has a dividend cover ratio of just 1, that means that all the profits are being paid out in the form of a dividend, and therefore any fall in profits could have negative connotations for that dividend yield. So let's have a look at the dividend cover ratios for some well-known companies. First off, we've got SSE. Now their cover ratio is just 0.7 times. So that shows that actually their current profits are not high enough to cover their dividend. And that implies they must be topping up their dividend yield with profits from previous years. And that's not sustainable on a long-term basis. So if you have got shares in SSE, then I would seriously think about whether you think that dividend is safe. Centrica, not much better. They've got a dividend cover ratio of 1, so any fall in their profits could have negative connotations for that dividend yield. Last up, we've got National Grid, which we mentioned earlier, dividend cover ratio of 1.2 times, so good news that it is above 1, but any serious fall in profits, again, could be bad news for that dividend yield. So I would recommend having a look at your portfolios and really thinking about whether you think all of the dividends in there are sustainable on a long-term basis. And finally, a piece of data in the US that we like to look at is housing starts, and this simply measures the number of new residential constructions that have been started in the last month. And if this number is going up, then it's thought to be good news for the economy, and in fact housing starts is considered to be a very good forward-looking indicator of economic health. And actually in the US this number has been going up over the last 3 months, and that is quite an encouraging sign for the economy. So have a look at the data here over the last year, so you can see over the last 3 months it has been rising. A possible reason for that is that the Federal Reserve has confirmed that interest rates will not be going up this year, and perhaps that's been giving a bit of confidence to both home buyers and also to house builders. So definitely something there that should be considered to be a bit of good news. Now, moving on to the week ahead, looking fairly quiet on the calendar, but we have got results coming out from Home Depot, TJX and Medtronic. That's it from us. Have a great weekend, and we'll see you next Friday.